Porsche shocked the automotive world after reporting a staggering 99% collapse in operating profit, one of the biggest financial drops in the company's modern history. A brand once known for massive earnings, luxury prestige, and industry-leading profit margins suddenly found itself fighting a serious crisis. Operating profit fell from around 4 billion euros to just 40 million euros during the first 3 quarters of 2025, sending fear through investors and raising huge questions about the future of the famous German automaker. For many people, the news felt almost impossible to believe. Porsche had spent decades building an image of strength, stability, and success. The company was considered one of the most profitable car brands in the world, often making more money per vehicle than many larger automakers. Whether it was a legendary 911 sports car, the luxurious Cayenne SUV, or the stylish Panamera sedan, Porsche had created a business that mixed performance, status, and exclusivity better than almost anyone else in the industry. But now, that powerful image is starting to crack under pressure from multiple directions. For years, Porsche was seen as one of the strongest and most successful car companies in the world. The German automaker built a reputation that most brands could only dream about. It sold luxury sports cars with huge profit margins, loyal customers, and a level of prestige that made owning one feel special. Whether it was a legendary 911, the aggressive Cayenne SUV, or the stylish Panamera, Porsche had managed to create cars that mix performance, luxury, and status better than almost anyone else. Even during difficult economic times, the company usually found a way to stay profitable. Investors loved Porsche because it made so much money from every vehicle sold. Car enthusiasts loved the brand because it still felt connected to driving passion and racing history. But in 2025, that image suddenly started to crack. The company shocked the automotive world after reporting one of the biggest profit collapses in its modern history. Operating profit dropped by an incredible 99%, falling from around 4 billion euros to only 40 million euros during the first 3 quarters of the year. For a company once considered nearly unstoppable, the news felt almost unbelievable. Even more surprising was the fact that Porsche executives openly admitted that the company's old business model was no longer working the way it once did. That statement alone created fear among investors and raised major questions about the future of the famous automaker. How could one of the most profitable luxury car brands in history suddenly face such massive problems? The answer is more complicated than many people think. Porsche is now dealing with several crises at the same time. The company is struggling with slower electric vehicle sales, rising competition from Chinese automakers, expensive development costs, changing customer preferences, and growing pressure from investors. At the same time, it is also facing a deeper identity problem. For decades, Porsche built its reputation around exciting sports cars and powerful gasoline engines. Now the company is trying to move into an electric future without losing the emotional connection that made the brand special in the first place. That challenge is proving far more difficult than expected. Customers still love Porsche, but many are confused about what the company is trying to become. Is it still the same sports car company that built legends like the 911, or is it turning into another luxury EV manufacturer focused on SUVs and technology? That uncertainty has created tension both inside and outside the company. The situation became even more serious after Porsche announced major job cuts, cost reduction plans, and leadership changes. A new CEO has now been brought in to help guide the company through one of the toughest moments in its recent history. While Porsche is far from bankruptcy, the pressure is growing quickly. Investors are nervous, competitors are becoming stronger, and the luxury electric vehicle market is no longer easy money. Companies from China are moving faster, offering more technology, lower prices, and modern features that younger buyers now expect. At the same time, customers in Europe and North America are becoming more cautious about fully electric cars due to charging concerns, economic uncertainty, and falling resale values. Porsche now finds itself stuck in the middle of a major industry transition that is changing the entire car world. The company must somehow protect its legendary image while also adapting to a completely new future. That balancing act could decide Whether Porsche remains one of the world's most respected car brands or becomes another luxury company struggling to survive in a rapidly changing market point, one of the biggest reasons behind Porsche's current crisis is the company's aggressive push toward electric vehicles. Like many automakers around the world, Porsche believed the future of the car industry would become fully electric much faster than it actually has. Governments across Europe were introducing stricter emissions rules. Politicians were talking about banning gasoline engines, and companies like Tesla were experiencing explosive growth. For Porsche executives, the message seemed clear. The company needed to move quickly into the EV market or risk being left behind. That decision led to massive investments in electric technology, battery systems, software development, and new vehicle platforms. The most important result of that strategy was the Taycan, Porsche's first fully electric car. When it was first revealed, many people believed it would become a huge success. The Taycan looked beautiful, delivered incredible performance, and carried the powerful Porsche name. Critics praised the handling, acceleration, and overall driving experience. For a moment, it seemed like Porsche had successfully entered the EV era. But over time, problems began to appear. Despite its strong performance, the Taycan faced serious challenges in the global market. One major issue was price. The car was extremely expensive, especially when compared to rivals offering more range and technology for less money. Many buyers also started comparing it directly to Tesla models, which often delivered better charging networks, software systems, and driving range. At the same time, Chinese electric vehicle companies were rapidly improving and entering the market with highly advanced vehicles packed with technology. Brands that barely existed a few years ago suddenly became serious competitors. Porsche realized that being a famous luxury brand was no longer enough to guarantee success in the electric era. Customers were now paying closer attention to software quality, battery range, charging speed, and digital features. In some areas, Porsche struggled to keep up. The company also faced delays and technical problems with software development, something that affected many German automakers during the EV transition. Another problem was timing. Porsche expected electric car demand to grow faster than it actually did. Instead, many consumers became hesitant about switching fully to EVs. Charging infrastructure in many countries remained weak, electricity costs increased, and concerns about battery lifespan and resale value started influencing buyers. Wealthy customers who loved Porsche often still preferred the emotional sound and feeling of traditional gasoline engines. That created a difficult situation for the company. Porsche had already spent billions preparing for an electric future, but the market was not moving as quickly as expected. The electric Macan SUV also became part of the problem. Porsche hoped it would become a major sales driver, but demand grew slower than planned. While EV sales still increased in Europe, the company realized it could not fully abandon combustion engines yet. As a result, Porsche was forced to change direction. Executives announced that future models originally planned as EV-only vehicles would now also include gasoline or hybrid versions. The upcoming 718 replacement would no longer be electric only, and future SUVs would include hybrid systems instead of relying completely on batteries. These decisions created enormous additional costs because the company now had developed multiple powertrain options at the same time. That flexibility may help Porsche survive in the short term, but also shows how badly the company misjudged the speed of the EV transition. Instead of leading a smooth revolution, Porsche is now trying to reverse some of its earlier decisions while still competing in an industry changing faster than ever before. Another major reason behind Porsche's financial collapse is the growing pressure coming from China, which was once one of the company's strongest and most profitable markets. For many years, Chinese customers loved European luxury brands. Owning a Porsche in China became a symbol of success, wealth, and social status. The country's fast-growing economy created millions of wealthy buyers who wanted premium German vehicles. Porsche benefited enormously from this trend. At one point, nearly one-third of all Porsche vehicles sold globally were going to customers in China. The company made huge profits there because Chinese buyers were often willing to spend large amounts of money on expensive options and luxury upgrades. For Porsche executives, China looked like an endless opportunity. But in recent years, the market started changing very quickly. Chinese consumers became more interested in domestic brands, especially in the electric vehicle segment. Local automakers improved at an incredible speed and began producing cars with advanced technology, luxurious interiors, and competitive pricing. Companies like BYD and several fast-rising startups started attracting younger buyers who cared more about innovation and smart features than traditional European prestige. Many Chinese EVs now include huge digital screens, advanced voice assistants, self-driving systems, and battery technology that rivals or even surpasses foreign competitors. At the same time, the Chinese government strongly supported local EV manufacturers through incentives and policies designed to strengthen the domestic auto industry. This created a difficult environment for foreign brands like Porsche. Suddenly, the company was no longer competing only against other luxury automakers, such as BMW or Mercedes-Benz. It was also fighting against ambitious Chinese companies moving much faster and adapting more quickly to changing trends. Porsche deliveries in China dropped sharply, falling by around 23% during the first 9 months of 2025. That decline represented nearly 10,000 fewer cars sold compared to the previous year. For most companies, such numbers would already be painful, but for Porsche, the impact was even more severe because China had become such an important profit center. Losing momentum there damaged both revenue and investor confidence. Another issue was that Chinese buyers increasingly viewed some foreign brands as slower and less exciting in the EV era. While Porsche still carried prestige, many customers felt local companies were offering better technology at more attractive prices. This shift shocked many European automakers because they had dominated the Chinese luxury market for years. Porsche also faced growing economic uncertainty inside China, slower economic growth, concerns about the property market, and cautious consumer spending affected luxury purchases. Wealthy buyers became more selective and less willing to spend huge amounts on expensive imported vehicles. Even loyal Porsche customers started reconsidering their options. At the same time, competition inside the luxury segment intensified. Every major car company wanted a larger share of the Chinese EV market, creating price pressure and reducing profit margins. Porsche found itself trapped between maintaining its luxury image and trying to stay competitive in an increasingly crowded market. The company could not simply lower prices too much because exclusivity is a key part of the Porsche brand. But refusing to adapt also risked losing even more customers. This situation created a dangerous balancing act. China was once Porsche's growth engine, but now it has become one of the company's biggest headaches. If Porsche cannot regain momentum there, the long-term consequences could be serious because the Chinese market remains one of the most important battlefields in the global automotive industry. While Porsche struggles in China and the electric vehicle market, the company is also facing a deeper identity crisis that may be even more dangerous in the long run. For decades, Porsche built its reputation around driving emotion, motorsport history, and iconic sports cars. The brand represented excitement, performance, and engineering excellence. The legendary 911 became one of the most respected sports cars in automotive history because it stayed true to its character while continuing to evolve over time. People did not just buy Porsche vehicles for transportation. They bought them because the cars made them feel something special. Driving a Porsche was meant to create an emotional connection between the machine and the driver. That feeling became the foundation of the brand's success. But as the company expanded into SUVs, luxury sedans, and now electric vehicles, some enthusiasts started questioning whether Porsche was slowly losing its soul. The Cayenne SUV saved Porsche financially years ago and became one of the company's best-selling models. Later, the Macan continued that success. From a business perspective, these vehicles were brilliant decisions because they generated huge profits and attracted new customers. However, they also shifted the company further away from its original sports car identity. Now the electric vehicle transition is pushing Porsche into even more unfamiliar territory. Electric cars are fast and technologically advanced, but they often lack the emotional sound and mechanical feeling that many Porsche fans love. Traditional enthusiasts enjoy the roar of a flat-six engine, the vibration of the car, and the connection between driver and machine. EVs deliver speed in a completely different way. They are smooth, quiet, and focus heavily on software and digital experiences. For younger buyers, that may be exciting, But for longtime Porsche fans, it can feel cold and disconnected. This creates a serious challenge for the company. Porsche must attract new EV customers while still keeping its loyal enthusiast base happy. That is not easy because those groups often want very different things. Investors also expect Porsche to continue growing profits, which pushes the company toward high-volume luxury SUVs and expensive electric models. But the more Porsche focuses on mass-market luxury products, the greater the risk of weakening the brand's unique identity. Some critics argue that Porsche is becoming too corporate and losing the raw spirit that once made it stand out. The company's growing lineup of SUVs and luxury electric vehicles has led some people to wonder if Porsche still prioritizes driving passion, or if it now mainly follows market trends and shareholder demands. Even inside the company, tensions appear to be growing. Management must decide what Porsche should represent in the future. Should it remain a focused sports car brand with strong enthusiast roots, or should it transform into a broader luxury technology company, competing directly with Tesla and Chinese EV brands? The answer may determine the company's long-term survival. Customers can forgive temporary financial problems, but losing brand identity is much more dangerous because it damages emotional loyalty. Once a luxury brand loses its special image, rebuilding that connection becomes extremely difficult. Porsche executives understand this risk, which is why the company recently decided to keep investing in gasoline engines and hybrid technology despite earlier EV promises. They know many customers still want traditional Porsche experiences. However, trying to satisfy everyone at once could also create confusion. Porsche now stands at a crossroads where every decision carries major consequences. The company must somehow modernize without abandoning the emotional DNA that made it legendary in the first place, as Porsche faces growing pressure from multiple directions. The financial impact inside the company has become impossible to ignore. The automaker is now aggressively cutting costs, reducing complexity, and preparing for a future that looks far less predictable than executives once expected. For years, Porsche enjoyed strong profit margins that allowed the company to invest heavily in new technology, motorsport programs, luxury features, and future development. Investors saw Porsche as one of the safest and most profitable brands in the automotive industry. But when profits suddenly collapsed, management realized immediate action was necessary. One of the biggest warning signs came when the company announced thousands of job cuts. Porsche revealed plans to remove around 3,900 positions by 2029, with reports suggesting even more reductions could follow later. Such moves are extremely serious for a company that had long been associated with growth and financial strength. Job cuts not only reduce costs, but also signal that executives expect difficult conditions to continue for several years. Employees inside Porsche are now facing uncertainty about the company's future direction. Engineers, designers, and factory workers all understand that the automotive industry is entering a dangerous transition period where even famous brands are no longer guaranteed success. Developing electric vehicles is incredibly expensive because companies must invest in batteries, software systems, charging technology, and entirely new production methods. At the same time, Porsche is also continuing to develop combustion engines and hybrid vehicles because customer demand for fully electric cars has not grown as quickly as expected. Supporting multiple technologies at once dramatically increases costs and complexity. Porsche now finds itself spending billions while profits shrink rapidly. Another problem is that luxury automakers cannot easily reduce quality or brand image to save money. Porsche customers expect premium materials, excellent performance, and high-end experiences. Cutting corners too aggressively could damage the brand's reputation even further.